Hey, folks, my guest today is Kurt Averill. He's the co founder and CEO of Ember, where he's responsible for leading the development and execution of long term strategies and identifying key opportunities for growth within the industry. He's obsessed with helping people own the vacation home of their dreams, where they can create lasting memories with family and friends. He's a serial entrepreneur and has taken more than one company from inception to scale, having raised over 70 million in venture capital financing at his prior startups. Kurt, you ready to take us to the top?
Absolutely. Thanks for having
All
me.
right. You bet, man. So before we get into Ember real quick on your backstory. So what was your last company?
Company's called Canopy. So Canopy's as a SaaS software solution for accountants.
Ah, interesting. And we're founder there, or did you join a little later on?
Founder. Yep.
Ah, very
Solo
cool.
founder. And took it from inception through scale, and it continues to do really, really well.
That's amazing. What year did you launch that business?
2014.
And this was the accounting practice management software?
Yeah, exactly.
Yeah. Get Canopy. Fascinating. Okay, so that was 2014. And then I guess what made you leave Canopy and jump into Ember?
So I left in 2019, took a bit of a sabbatical, and then kind of went back to my roots. My family is kind of a generational home builder. And so my parents and then also my grandparents built second homes for people in Lake Arrowhead, California, which is a destination outside of Los Angeles.
Interesting. Now, how did you replace yourself? I mean, obviously, I think you guys raised significant capital there. How much did you raise at Canopy?
We raised, at the time that I left, it was about 70 million.
Yeah. So that would have been what? That would have been just post Series C.
It was like a B1, I think.
Yeah, you guys have quite the fun. I'm looking at, you have quite the funding history. Not traditional. There's some debt mixed in. There's some up, down, all over the place, huh?
Yeah.
Okay, so I guess that's a good lesson here first too. Before we jump into Ember, how did you replace yourself as founder? Right, so leave it in good hands and make sure you're exiting gracefully there.
Yeah, I mean, I think like as founders, you have to realize that there's going to be a time when you're there with the company growing it, and then there's going to be a time when it's time to move on. And for me, it was like a deeply personal decision to move on to the next thing. The way I viewed it is, I think, I thought that after 5 years of being a founder at a high growth startup, you're ready for a sabbatical. And so taking a sabbatical was probably one of the best things I've ever done. And then, B, I think, as an entrepreneur, what I love to do is build and create. And so I knew that I could go out and build, the next thing. And that's what really gets me, that's what motivates me. It's what keeps me going in the morning and gets me up and rolling.
Mm-hmm. And are you able to share when you left there in 2019? You sort of went from zero in 2014 to how much ARR when you left?
Oh yeah, no, I'm not able to share, unfortunately. Yeah.
Okay. No problem.
When you leave, you're always under strict NDAs. It's the way it works.
Yeah, I mean, it's your company. That was 3-4 years ago. I'd be surprised if those are still active today. You can't share anything about the range you grew it to besides the amount of capital you raised.
Yeah, just the amount of capital raised.
I just think it's terrible to judge any company on how much capital they raised. It's a horrible metric of growth.
100% agree. 100%
Okay.
agree.
All right, Ember, you go back to your roots. Why vacation homes? Why partial ownership, if that's the model? And explain the marketplace to me.
Yeah, so we kind of fit right in between, an Airbnb and a whole home vacation home, right? So if you think about your options, you have a handful, right? When you go on vacation, our thesis is, we're looking for people who are going to the same vacation destination on a regular basis, right? These are typically vacation destinations that sit right outside of a large metropolitan area. So it'd be St. George, Utah, which is a gateway to Zions National Park, to Salt Lake City. It'd be Bend, Oregon to Portland. It might be the Hamptons to New York City, or, Cape Cod to Boston, where you're going on a regular basis, right? And for that, your options are basically to Airbnb, which is, fairly expensive, as we know, and then, or you buy a home outright. But the challenge with buying a home outright, I mean, it comes with the benefit of having the home and being able to use it whenever you want. The downside is most second home owners don't use the home that often. And so, they think they're going to be there 6 months out of the year, but they end up only being there 6 to 8 weeks out of the year. And then that second home becomes a second job, because homes are work. And, whether it's just fixing a faucet or paying your property taxes, that's just work. It's just a lot of things that are going on in that home. So what Ember does is kind of bridges a gap. It sits right between an Airbnb and a full home ownership, where we take a home and we buy it with an LLC and then split it into 8 different shares. And a person can buy anywhere from 1 to 4 shares of that home. Now, think about these homes. These are high-end vacation homes. The goal is to like make it so that when you walk in, there's a wow factor. Your friends and family walk in. When we buy the homes, they're high-end. Then we also furnish the homes and with high-end furnishings and hand it over to the owner group totally turnkey. At that point, we manage the property so that we abstract all of the work that comes with a second home away from the ownership group so that they can just enjoy their vacation, but while still retaining that ownership in the asset that can appreciate over time.
Oh, what's going on there, YouTube? Good to see you guys. Now imagine this. You love watching these interviews with SaaS founders, but imagine if we took all of the valuation data out from over 2,807 interviews I've done manually. Saves you a lot of time. Well, we've done this. We've built it into the beautiful interface inside of FounderPath. Check this out. I'll show you how you can access this in a second, but you log in, you connect your Stripe account, you see your valuation real time. You can see what it changed over the past 88 days and even set goals for valuation this year. Now, the secret to valuation is there's many different ways to value a SaaS business. So the reason you're going to see 3 or 4 different valuations inside of your FounderPath dashboard, this is all free by the way, is because depending on who's doing the buying of your SaaS company, you're going to get a different valuation. A VC is going to pay a different valuation. Private equity firm is different. If you're going to do a minority sale, that's different. And if you sell the whole business, that's a different valuation. You can see all those when I hover over here. Right, so the teal is what a VC would pay, yellow is what private equity, and red is if you sold the whole thing outright. Now, what's cool about this is not built off random data. Again, you guys hear these interviews on YouTube. All these data are built from real-time valuation data points founders share with us on the show. So traction, 1.2 million, seed round, 3.7 raise, they sold 22% of their business. Go in here and filter by the event. Maybe you only want to see companies that have sold the whole business. Well, here are a bunch that have been acquired, the valuation and the multiple. Maybe you're going out right now and you're raising your seed round. Well, go in here and look at all this recent seed deals that went down, what they raised, what valuation they raised at, and what percent that they sold. There's never been a larger data set of SaaS valuations than what you can get now inside of FounderPath, and we're thrilled to bring it to you. All right, we're going to go back to the YouTube video here in a second, but if you want to check this tool out, if you want to jump in and sign up, you can check it out for free to get your valuation at this link, founderpath.com/products/valuations. Or if you go to founderpath.com and hover over products, click on get your valuation here and go ahead and sign up to give it a whirl. Again, all that valuation data live right inside the platform. I hope to see you there. All right, let's jump back into the interview. Yep, let's look specifically at 2293 North Cerritos Road, Palm Springs, California. You've got it listed right now up on the site as potential buy, $224,560. Now, is that what you would pay for 1/8 ownership, or is that the total price of that? That's not the total price of the house.
That's the 1/8 ownership. Yeah. That's right.
Yeah.
Now, what that does, it gives you 6 weeks out of the year at that home. And, if you wanted to be there 6 months out of the year, you buy, half the home instead of 1/8, which we have some customers who do.
Yeah, so $224,000 for 1/8. The home price is about 1.8 million total. If you want to buy more than 44 nights per year, you just buy 2, 3, 4, 5/8 of the ownership stake. Have you pre-negotiated basically almost like a ROFR with the current owner or an option agreement with the current owner? How do you generate the supply on your marketplace?
Yeah, so for most of our homes on the marketplace, we actually go in and buy the home. We have a pretty good sense of what our buyers want in their homes. And so we go buy the home in the first instance, and then we market the home to the buyers. In this case, with the home in Palm Springs, that's a potential buy. So we have 2 different categories of homes. We have homes that are for sale. So you can look in Newport Beach, you'll see some there. Those homes that are for sale are homes that we actually own. And now we're actively selling shares in those properties. The potential buys, like the one in Palm Springs, that's a home that we could buy if we had enough interest in the home. So we kind of put the potential buys up there to provide some diversity and then also gauge interest in that particular home.
Mm-hmm. What prevents someone sophisticated like a Blackstone to hire a data engineer to scrape your site, Picasso, and others, where you have basically labeled these yellow labels potential home, just go buy them ahead of you, right ahead of your ability to close it if you have interest?
Yeah, they could. I mean, they definitely could. The thing is, this is a massive market. It's a massive market. We're talking about the largest asset class in the world, real estate. And so we think there's going to be a couple large players, and we kind of welcome that. It's a new asset class. There's a lot of education layers, but people who buy in, they love it. They love the experience. So right now it's basically the two big players in the space are Picasso and Ember. There are a couple others that are smaller, but those are the two big ones.
And how do you measure size? Is it literally GMV through platform, number of closed deals?
Yeah, I mean, I would look at it kind of in inventory. So, clearly, Picasso's been very aggressive and is a couple years ahead of us on their growth trajectory. So they've got inventory, coast to coast, and Ember is mainly on the West Coast. So it's Oregon, California, Utah.
Interesting. And I mean, what would you, I guess you can look at number of unique properties. You can add up the total amount of the value of the properties, like the 1.8 million place in Palm Springs. Like, I mean, what do you try to get to, or how far can you stretch your supply side here? I mean, do you want to have 100 million of sort of listings on the platform, or what's that number?
Yeah, I mean, I think it will get very big. Yeah, so we've been doing this for 10 months. My co-founders and I, and then our team at Ember, and the company's grown very quickly. So right now we have, just shy of, we're right around $15 million of inventory that's available on the website. Okay. That's homes that we actually have purchased and are for sale. So I think that will grow into the hundreds of millions over the course of the next few years. And, the way we think about it, if you look out 5 to 10 years, which is what you got to do in a startup, right? You got to think about what this will be. This is going to be a massive marketplace where people are buying and selling shares in these homes. And it's the way that our thesis is that this is how people will buy vacation homes. The old way of buying whole homes, which with all the work and costs that comes with that, will start to fade. And certainly there'll be a segment of the market that will still buy the home outright. But for most people, they want to be able to show up and have a worry-free vacation and not really have to deal when they leave at the end of their vacation, they leave all the troubles of the home behind to Ember. So yeah, we think that there's like a, multi-$100 million, certainly, potentially into the billions of dollars of inventory if you go out 10 years, and that's kind of where we're headed.
So Ember got going about 10 months ago. Did I heard that correct?
Yeah.
And so how you said you've purchased already $15 million to feed the inventory we currently see on the site?
Yeah. So we have $15 million live. We've actually sold quite a lot more than that.
Oh, interesting. So over the past 10 months, you've bought way more than 15 million. 15 million is just what you've bought currently that hasn't sold yet. It's sort of in the middle right now.
Yep. That's actually for sale on the website right now.
I see. How much have you moved over the past 12 months?
It's in the tens of millions. Yeah.
Oh, wow.
We've moved in the tens of millions of inventory across the website. So there are a lot of homes that we have purchased and sold that are no longer listed on the website. Obviously, once we sell them, we take them off the website.
Yep. Do you think you can break $100 million of sort of GMV, this year?
Oh yeah, absolutely. Yeah,
okay.
Based on the current growth, 100%.
Do macroeconomics matter? Interest rates going up, people can't get loans as easily. Does this matter?
They do matter. Yeah, they do matter. I think we're obviously high in vacation homes. It's usually a discretionary spending. We watch it pretty closely. That said, the growth trajectory to date hasn't been impacted. We're continuing to grow in what I would characterize as kind of the top, 1% of startups. Yep. And the company operates, we're pretty tight-lipped about like absolute numbers, but I can tell you we operate pretty close to a break even. Like we've not burned hardly any cash.
Oh, nice.
Most of the cash that we put on the balance sheet is to buy inventory. And so, yeah, I think like you could see a 3, 4, 5x growth over the next 12 months, based on what we know of the market over the last 12.
Where did you get the cash to buy up all the inventory? I mean, to get going.
So it's a combination of the equity dollars that we raised from the venture side, and then we also layer in a debt, some debt on top of that. That gives us kind of the purchasing power. The one thing I'd mentioned that you brought up was the interest rate. So typically, when you think of like a 1/8 ownership in a home, you're not thinking like, oh, that's something that can be financed, right? That in fact, historically, that's not a product that would have been financeable, but that's actually not the case with these shares. Like these shares can be financed. We have a partnership with a bank that finances these shares at a low interest rate. In fact, in the Newport Beach homes, the interest rate's 4%. So it's actually less expensive than a traditional mortgage in kind of the current environment, which is amazing.
Very interesting. Now you mentioned equity, so it sounds like you've closed a seed round. When was that, and how much was it for?
Yeah, so we closed a seed and an A, which we kind of announced together at a $17.4 million financing. The A was led by Peter Thiel, so we were super excited about that, to have him lead that financing, and we closed that in February.
Okay, and if you split that out, how much was the Series A?
The Series A was 15, and the seed was 2.4.
Interesting. Okay, so a lot of your early inventory was really fueled by, it sounds like a great debt deal you got done, which is nice because there's real collateral here to get a debt deal done. I mean, when you talk about fintech and SaaS today, you're seeing people raise these warehouse facilities and bankruptcy remote SPVs, and there's no collateral except like software contracts or invoice factoring, right? Did you sort of use the same structure though, but your collateral is not a contract or an invoice, it's the actual house?
Correct. Yep.
Interesting. And how much, I mean, you obviously have track record, right? So you have history here. I mean, how big of a debt facility were you able to raise on day one to go fuel this supply?
So we have raised, roughly, well, on the debt side, there's several different sources of debt that we use to make this happen. And, it's probably in the $20 to $30 million right now on the debt side, and the combination of everything collectively.
Okay. Interesting. And do you want to keep holding that debt even when you move that house off your site? Because buyers buy all 8 shares, because obviously that's a revenue stream for you potentially, right? You can pass those costs on.
Yeah. So it's really just designed to be acquisition debt. So we'll acquire the property in the first instance, and then the property will move hands to the new owners. If that owner decides to finance a portion of their purchase of the share, then there will be some debt that remains on the property. But in a lot of our homes, it's been cash buyers. So
I see.
That debt is financed out entirely, and then the owners own the home outright, kind of indefinitely.
And you can sort of recycle there. Very interesting. Okay, let's talk. Averages are dangerous, but it helps really understand a marketplace quickly. What's the average sale price of the home on the platform?
So it depends on the geography. In St. George, Utah, which again is, if you've ever seen the Red Rock, of southern Utah, that's where St. George is. So it's a beautiful area. It's actually a very big vacation destination. Your homes are typically between $2 and $3.5 million. Okay. In Newport Beach, that ranges from $4.5 to $8 million. So we have 2 homes there actually on the low end, was $4 million, but you're talking about a home that's in a stunning neighborhood and 90 steps to the sand.
Yeah, they're beautiful. I mean, I'm looking through a bunch of them now. They're beautiful. So it sounds like sometime across, geography matters, but somewhere between sort of a $3 to $4, maybe $5 million sort of average is around the sale price. Help me understand how you guys make money. You sell a place for $4 million. How do you make money?
Yeah, so we're super transparent about it, right? Like our goal is to make sure that the consumer, when they come in and look at it, they understand exactly how the pricing works. So we purchase the home outright. We provide, the REPC, which is the real estate purchase contract to the customer, so they can see that this is what we paid, and this is all listed out on the website. Then we add furnishings on there. So let's just take an example. Let's say it's a $2 million, or let's say it's a $4 million home down in Newport Beach. We'll break this out as $4 million for the real estate, another $250,000 to $300,000 for the furnishings. That includes closing costs, really well-appointed home, window treatments, appliances, et cetera. We also throw in beach cruisers and things like that. So that when people show up at the houses, it's like they have all the toys that they would expect to have at the beach. And then where we make the money is on that, we're right now at $4.3 million, the $4 million purchase price of the home, $300,000 of furnishings. We take a 12% uplift. So we'll take that 4.3, multiply it by 12%, and that's where Ember makes its money. And so we break that out as kind of line items so that everybody can see exactly where that revenue comes. Now that's a one-time revenue source. On the recurring side, and this kind of fits into both kind of the SaaS and kind of prop tech side of things, there's a platform fee. So that platform fee is $100 a month per share. That covers the management of the LLC and then a tech layer. So there's an app. The app is what handles all the scheduling. You can kind of think about it like an Airbnb, scheduling app where you've got a calendar. You can go into any time. So there's not set weeks. This is not a timeshare. This is not like, hey, you get the 44th week of the year. It's a first come first serve. You can come down for one night or 14 nights, and then property management, right? Actually managing the property in kind of a traditional property management sense. That's kind of the recurring revenue side of the business.
And how many shares do you think you'll sell this year?
Well, we've had over 100 families buy in to Ember to date over the past 10 months. And we expect to, double or triple that number toward, the end of the year or so.
And are most times those families are buying one share? So it's a 1-to-1 ratio?
Most families right now are buying one share. We've just added the financing layer. And I think with the financing layer, you're going to see, more people buying 2 shares, a quarter of the home, having more time at the house.
Yep. Okay, good. So we can take 100 families, each owning about one share, times $100 a pop there monthly. You're already at $10,000 in MRR, not including your 12% uplift.
Correct.
Yeah. Okay. Wow. Fascinating. And you said earlier you have 15 million sort of available today, but you've already sold multiples of that. So if we assume conservative 30 million, we could take 30 million times 12% uplift, right?
Good. Yeah.
3.6 million already there on uplift. 10 months in is pretty good. Pretty good
for 10 months.
Why is that potential? That's actual, right? Why would it not be 12%? Have you always had 12%?
Yeah, it's always been 12%. Yeah.
Okay. So there we can brag about you a little bit. Okay. That's pretty good for 10 months in.
That's not too bad.
Is the model working? Do you think you anticipate any pricing changes? Is 12% too high, too low?
I think the model is working. So, the value that Ember provides and the reason people are willing to pay, a 12% uplift on their shares, because we're unbundling an asset, right? You're taking an asset that was previously unavailable to a group of buyers, and you're making it more affordable and turnkey for them. And because of that, they're willing to pay a little bit of a premium. It's kind of like, the analogy that one of my co-founders uses is like, you can buy a 6-pack of Coke back in the back of the grocery store that's not cold and on the shelf for a couple bucks, but you inevitably pick up that cold one that's like, already set out in the refrigerator, in the aisle, in the checkout aisle. And so you're essentially just taking that asset and unbundling it. And there's a lot of value in that. So I would say, 100%, we've got pretty strong product market fit. We've actually had more of an issue keeping up with demand on the buy side and being able to get the inventory, which is always a good problem to have in a startup.
Yep. No, that's tough. Now, in terms of funding, obviously dilution, you want to manage that. You've been through this rodeo before, so you know all about dilution with your last company. But most folks say, closing Series A's, they're selling, call it 10 to 15% of the business. Were you sort of pretty standard there?
Yeah, I'd say it's pretty standard.
Okay, got it. So you're talking like 100 million valuation, something around there.
Mm-hmm.
Okay, interesting. What's team size today? How many folks?
So we're just shy of 30 people right now.
30. And how heavy on engineering? How many engineers?
On the engineering side, that makes up, roughly 5. So it's interesting. Yeah, 5 of the 30.
Okay, 5. And look, anyone listening is going to go, wait, this guy's rich. Why does he want to sell 10%, 20% of his business over 2 rounds, the seed and Series A to investors? Why not sort of be greedy, bet on himself, and keep as much to 100% as possible? How would you answer that?
There's a couple things. One is, it's a fairly capital intensive business. Obviously, we got to go out and acquire the property in the first instance and then sell the property. So there's reasons to have a lot of cash on the balance sheet so that you can take that cash and leverage it. I also think that there's going to be a couple big players in this space, and we're kind of starting to see those players form. And, the way we view this kind of 5-10 years out is this is a nationwide marketplace and also a worldwide marketplace where people are buying and selling shares. And I think speed to market is really critical for marketplaces. If you get out there and kind of establish the name, that's what gets you in kind of in a first or second position. And so we're going to be pretty aggressive. And to be aggressive, it's helpful to have the insight and backing of venture capitalists.
Yeah. Look, this is my preferred way of living, right? I'm here in my house in Austin right now, but I travel most of the time. My preference is to have 5 or 6 cities I'm in each year. And I go a week here, a week there, and be able to do this. So the challenge with something like Ember is if I want to become an Ember loyalist and go on today, well, there's only really 5 cities I can spend my time in. I love Barcelona. You don't have Barcelona. I love whatever. I'm making this up. Sayulita in Mexico. You don't have that yet. So there really are network effects here, right? Whoever gets the most inventory the quickest wins. Isn't that true?
100%. Yeah, 100%.
Yeah, interesting. And you feel like you can catch up. What's your mousetrap? How do you catch up to like a Picasso?
So I think there's a couple things. I mean, I think this is a massive, like I mentioned, it's a massive asset class, and there's no way that, one player can kind of capture an entire market. This is not an Airbnb. Like, you think about an Airbnb where you go to an Airbnb and you go there you go there. It doesn't matter where you're traveling in the world, right? If you're going to go out to, Barcelona or to London or, to Newport Beach, you're probably going to go to an Airbnb and go to single source. This is not really that, right? This is a very localized, regional, home buying is a very regional, localized, I think buying process. And it's also a much larger asset class. So one is, I think that there's space for several players to coexist. Two is, we're in a slightly different price range than Picasso. Picasso's in the ultra luxury side of the business, right? Like, taking what was available to, 0.1% of Americans and making it available to the 1%.
What do you think their average sale price is? You think it's closer to like 9-10 million?
Oh yeah, for sure. Yeah, if you browse kind of through their Newport Beach homes, it's just a much higher price point. 2 to 3x what Ember is. Where Ember is coming down market a little bit and say maybe what's available to the 3% is now becoming available to the 20 to 25%. And so that democratization is part of our strategy. And even if there's encroachment on those pricing, there's just so much space in the market that it's not too concerning. So, in our minds, it's just expansion, right? To your point, we have people who want to have a desert home, a beach home, a mountain home. And so as we expand, it's like, get to the East Coast quickly. Now that we've kind of got a handle on the West Coast and continue to build out the West Coast, then East Coast, and then Europe. And I think, it's the makings of a very big business for both of us.
So I'm in Bend, Oregon. I love this place that sleeps 14, 6 beds, 7 baths. I'm going to buy $419,000 for 1/8 of this share. The flip side of this is, though, I sort of have 8 co-founders. 3 years from now, markets are way up. Everything's up. And I'm like, wow, this little share is worth a lot of money. I want to exit and go move to Cape Town. What if there is no buyer on Ember for it? I can't just list my house with a realtor because there's 7 other co-founders I have to get to agree with me. You know what I mean?
Oh yeah. So this is the magic of Ember. So when you're ready to sell your home or your share in your home, you can sell it at any time. And because
you guarantee that you'll buy it.
You can sell it on the MLS with the real estate agent at any time at whatever price you want. So let's say the home went up, 30%. And now instead of $410,000, you're sitting at over $500,000 for that share. You go list it on the MLS, and Ember will help you do that. And then you sell that share to another buyer, and you can buy a share out in Cape Cod or wherever you want to buy. So that
interesting.
The amazing thing, and this is part of the magic, is unlike a full home where you have to actually go through, underwriting and title and et cetera. This is like a 24-hour transaction. You list the property, it goes up on the MLS, it goes on Ember's website. We bring in a buyer, the buyer buys a share, and they can actually close on that share in 24 hours because what they're buying is a membership interest in an LLC, not the actual real estate. So that process of buying and selling these shares is part of the benefit of owning.
And someone's done that already. Has someone done that?
What we've had several customers upgrade. So it's been interesting. Nobody's sold their out of Ember because once you've experienced it and tasted it, it's something you can't really let go of, right? Because it is such an amazing experience. But what we have had is customers who said, you know what? We love the home that we're in, but there's a new home that you just listed, and we would like to buy a share in that home and sell the share that we have in our existing home. And actually, during the first year of ownership, you can trade without any fees. So no real estate commission. So if you find a better listing, there's kind of like an Ember guarantee. You can just move to the other property. Maybe it's a bigger house or a smaller house or a different location within the first year. After the first year, it's just the traditional 3% real estate agent commission. And, in this case, they were within their first year. So they upgraded to a larger home. We took the shares that they had and we sold them on the open market.
Really interesting. Yeah, really interesting. Well, look, I think this is sort of definitely the future, at least certainly for somebody like me. It's just a question of who has the inventory the fastest, where I can just become literally an Ember loyalist and go anywhere I want, whenever I want, and own the house, 1/8 of the share. So
100%.
very cool. All right, great story here. Let's wrap up with the famous five. Number one, favorite book.
Favorite book? Hard Things About Hard Things.
Number two, is there a CEO you're following or studying?
It's probably a little bit, I guess I would probably say Steve Jobs. I mean, it's probably one of the most common answers that people give. But I think kind of his work ethic and his ability to innovate across multiple products. That's what's so remarkable about him is, a lot of entrepreneurs can nail one, but Steve Jobs hit multiple products and was able to innovate. And that part is extremely difficult to do and also, super inspiring.
Number three, what's your favorite online tool for building Ember?
Favorite online tool? Well, it's hard not to go back to some of kind of the sales, some of the sales tools and reporting on like HubSpot and Salesforce. Those are the first that come to mind because obviously, as a startup, we're super sales driven. So that's probably where I'd hang my hat.
Number four, Kurt, how many hours of sleep do you get every night?
6 hours.
Okay, that's good. And situation, married, single, kids?
Married with kids.
How many kiddos?
4. Ages,
oh my God.
Yeah, 15 to 8.
Wow, busy guy. Okay, how old are you?
42.
42. Last question. Something you wish you knew when you were 20.
So I wish I'd been in tech a lot sooner than I was. I started as an attorney in Manhattan. And I think I wish I'd gotten in tech sooner. And then I also ended up learning how to code. So I've been on the engineering side and I wish I'd learned how to code sooner.
Guys, yeah, that makes a ton of sense. Guys, there you have it. Ember Home. Again, if you believe that the future is about going and living wherever you want, whenever you want, but you don't want to buy outright houses in all these places you're going to spend 4 or 5 weeks a year in, Ember is a great solution for you. Very interesting space. You can go buy 1/8 of a share in Palm Springs for $400,000. You then pay $100 a month to use the Ember application to book those times, first come, first serve, to trade your shares into other houses if you want. They're off to a nice start here. 10 months in, they raised about $17.4 million in capital because they actually buy these houses. They hold them until they sell them. They have about 15 million in houses they've bought today that they're waiting to sell on the site. They've already turned over multiples of that. So call it maybe 20, 30 million already through the platform. They take a 12% fee on top of that. So if they did 30 million bucks in volume, 12% fee would be about 3.6 million there. But again, already on the recurring revenue side, $100 per share, 100 families. That's about, again, $10,000, $11,000 per month already in MRR as Kurt looks to scale the business. Kurt, thanks for taking us to the top.
Hey, likewise. Thanks so much for having me.
One more thing before you go. We have a brand new show every Thursday at 1 p.m. Central. It's called Shark Tank for SaaS. We call it Deal or Bust. One founder comes on, 3 hungry buyers, they try and do a deal live, and the founder shares back-end dashboards, their expenses, their revenue, ARPU, CAC, LTV, you name it, they share it. And the buyers try and make a deal live. It is fun to watch every Thursday, 1 p.m. Central. Additionally, remember, these recorded founder interviews go live. We release them here on YouTube every day at 2 p.m. Central. To make sure you don't miss any of that, make sure you click the subscribe button below here on YouTube, the big red button, and then click the little bell notification to make sure you get notifications when we do go live. I wouldn't want you to miss breaking news in the SaaS world, whether it's an acquisition, a big fundraise, a big sale, a big profitability statement, or something else. I don't want you to miss it. Additionally, if you want to take this conversation deeper and further, we have by far the largest private Slack community for B2B SaaS founders. You want to get in there. We've probably talked about your tool if you're running a company or your firm if you're investing. You can go in there and quickly search and see what people are saying. Sign up for that at nathanlatka.com/Slack. In the meantime, I'm hanging out with you here on YouTube. I'll be in the comments for the next 30 minutes. Feel free to let me know what you thought about this episode. And if you enjoyed it, click the thumbs up. We get a lot of haters that are mad at how aggressive I am on these shows, but I do it so that we can all learn. We have to counter those people. We got to push them away. Click the thumbs up below to counter them and know that I appreciate your guys' support. All right, I'll be in the comments. See ya.